Hello guys, in this video I will try just to answer question how to avoid the gap down. Now the first obvious thing is the earning dates. If you want to buy a stock, try to check the earning dates. It means when the company announces the earning, it has a date. Sometimes they give the exact date. They give you, is it before the market opens, or is it during the market when it is open, or is it after the market close? Okay, three time. Sometimes they don't tell you. They tell you the date. They don't tell you when. Okay, so for you, if you don't like this gap up or gap down, you don't like this big movement in the stock, and you get frustrated, and I know when it's a gap up you like it. Okay, I know you like it, but when it goes down you don't like it. I know, but try not to trade this stock. Okay, second thing, let me drink some coffee first. Second thing you do, what is it? Is check the history of the stock itself, like 1 year, 2 years. Check if this stock is doing gap up or gap down. Okay, it shouldn't be always gap up, it shouldn't be always gap down, but some stocks are very sensitive to news because a lot of people are watching these kind of stocks. I give you an example: Twitter, Facebook, Apple, Google, and other stocks that I don't mention. All these kind of stocks, there are millions of people here in America and millions of people in the world. They are always looking at this kind of stocks. They watch them, they follow them, and sometimes these people, they like to get an adventure and buy them before the earning date, and they say, okay, if we can make a lot of money from a gap up, why not? But they accept the loss also. It's, you know, it's just a way of trading. People, they like it. Okay, now one time I have seen Google, there is like I think gap up with $130 gap up. It means if you buy one share of Google at that time, you will get $130 for that share, like profit. Okay, so this is a big money. Now, so these two techniques that I say are very important to avoid gap down. I said earning dates, try to just avoid them. You see, for example, earning dates, let's say it is on Friday and you are on Thursday, and you don't want, because if you buy today, tomorrow is the earning dates, so you will have problem. So avoid that. Now, second thing I say, check the history of the stock. See this stock, if it is sensitive to gap up or gap down, it means you see it. Okay, you can see it in the chart. If it's going up and down, up and down, up and down, it means that this stock could have like a gap up and gap down. So avoid this kind of stocks. Now, a third thing is you will never know. Sometimes a stock has never done a gap up or gap down, and suddenly there is a gap down. A gap down, it's not just a gap down that you can see with few dollars. Some stocks, they lose 80%, 90% of the stock is gone. And most of these companies are, in general, are in drugs sector. Why? Because it has a relation with the government. When they accept some medicine, or if they accept the projects of these companies, their stock can go. I give you an example before. The stock was $3. In 1 year and a half, it goes to $265. And I still remember this kind of stock because I trade it. It's called PCYC. I don't know if the company is still there or it is sold. I don't know. But it was $3 and it goes to $265 in 1 year and a half. Why? Because I think it wins some medicine thing related to drugs. Okay? Now, there are some companies that they have a gap down. It means they lose. It means they were in a big project and the whole company is based on that project. Okay? But they lost because the government was against them or because they don't approve. Now, when the short sellers in the world, the big hedge fund, they hear this news, they just go to this stock and they bombard it with billions of dollars and they put it down. A stock can be $20. Tomorrow you will find it with $1 or $2. It happens. Okay? So, in general, try to avoid the volatile stocks like drug sector, internet sector. These kind of stocks, they are very volatile. Now, if you don't want a lot of problems, go to financial loans, insurance. Those are stocks that they, like a turtle. It means they go slowly. Okay, and people they don't suffer a lot. Or you can buy an index like ETF for this kind of stocks, or you can buy a mutual fund because the movement of mutual fund is slow, and you don't lose that much. Okay. So these are the techniques that I showed you, or the explanation. And if you have more information or more to add to what I say, it's a very good idea. Okay? But understand that the market, you can't say this kind of stocks, they will never have a gap up or down. You should never say that, because sometimes it happens here and there. Some stuff that, that's why I told you before, and you should, by many years of listening to me, you should understand that the market is logical always. It gives you things that you have never expected, surprises. Okay? Surprises. One time, it's just a surprise. I don't know. I have never seen whatever news, or I just bought a stock according to my criteria. It was $78. The next morning, I find it $135. So when I see that money, man, I just sold all my shares. I will never wait 1 minute. If you tell me just wait 1 day, just to see what's going on after the gap up, no, I will not wait. I see some money. It's a big money. It's a big gap up. I take that money from the market and put it in my account safely. This is a safe money. When you get the profit, put it in your account. Safe. It is safe now. I don't want to wait many days more and to see if the stock continues to go up. I don't care if it goes up or go down. For me, I see something, I take it. Now, thank you very much for watching for this video. As I told you before, try just to listen again if you miss something. If you have something to add, please add this thing, and thank you very much and have a nice day.